Ladies and gentlemen, welcome to the first ever FinTech Club debate. We're making Franklin history. All right, so on one side we have Professor Turtsey, macroeconomics professor. All right, many of you know him. He is a legend. And on the other hand, we have Connor, who is a crypto enthusiast and also the president of the FinTech Club here. So please cheer him up. All right. So the way this is going to work is we're going to have 10 minutes of opening remarks. Both parties will try to get to an agreement, which hopefully they will not. And then we are going to let the floor open to questions. So think of questions you want to ask them and what kind of different perspectives you want to get into the crypto markets. All right, so we're going to kick it off with opening remarks. Connor?
All right, can everybody hear me all right? Great. All right, so as most of you know, and for those of you that don't, the primary focus of this debate is going to be about the future of government-issued currency, which is called fiat currency, like the US dollar, the euro, and cryptocurrency, like Bitcoin, Ethereum, and Dash, Monero, Ripple, all these other currencies that are online based on the blockchain technology and typically have a limited supply as opposed to fiat currencies which have a supply that is regulated by a central bank. So from my perspective, we have a big problem with the economy, a huge problem. And that problem is that we have a monopolist issuer of currency sitting atop the economy in the form of a central bank that has the effect of extracting rents from the and causing bubbles in our economy and causing problems. Basically, in the 1990s, an economist by the name of Milton Friedman predicted actually that digital cash would be created as a method of transferring value around the world without governments being allowed to easily tax it. And as a result, in the 2009 financial crisis, 2008 to 2010, Bitcoin was created. And actually in one of the early blocks of code, the creators of Bitcoin said, Central Bank of the United States has been embarking on a policy of quantitative easing, which is basically increasing the supply of liquidity into the economy beyond what the market would ordinarily do. And this is my fundamental thesis. Right now, in the central bank controlled financial system, there isn't a free market for things like government debt, and the price of money is therefore controlled by a centrally planned a central authority. It's like central planning in the communist sense. And as we know from the Soviet Union, that central planning has created massive problems in communist systems. And that's really no different from the current system we have with central banking. We have a small number of individuals at the top, which are not elected, and they have an outsized influence over the direction of the economy. This is exactly how a command economy works and not how a free market economy works. And I think that one of the most important things to note about the rise of crypto and cryptocurrencies is that we're changing from a system where the banking monopolies, like the Goldman Sachs, the JP Morgan Chase, the giant behemoths that are so large and uncontrollably, they're sort of uncontrollable. They cannot fail. In an ordinary system, in a properly functioning financial system, I don't think there should be institutions that are so large and have risks that are so unwieldy that they can cause crises, even if it's unintentional, like 2009. There is no way that the free market would price risk in such a way to allow that to happen, and yet it has. So to continue here, it's entirely plausible that the best scenario for a global economy is a well-run central banking system. It's also possible that the widespread adoption of cryptocurrency as a reserve currency could lead to complications and possibly be inferior to the current system in some regards. But I prefer to focus on positive economics, which is what is or is likely to be, rather than on normative economics, which is trying to divine what should be. And signs point that the central banking system has been making several mistakes, and a transition to cryptocurrencies is not only likely, but probable. People and capital will naturally gravitate toward a free market, not a centrally planned one. The smart money has already dumped fiat. The dumb money will continue to crowd into cryptocurrencies when the debt-based fiat system experiences a large enough financial crisis, a global financial crisis, like in 2009. Centrally planned economies have always collapsed and transitioned to the free market. They'll try and convince you through Keynesian economics, etc., that there needs to be constantly more debt and debt-based money. And the problem with this system is that what happens when it doesn't work? Right now, the economy is stagnant. It's been stagnating. In Japan, we have government debt levels of 180% of GDP, or possibly even more than 200%. Clearly, more debt is not working. And not only is it not working, but it's slowing down the economy and it's creating additional inequality. Slowing down the growth of the economy, that is. So central banks centrally plan, and even if the professed reason is to regulate the economy for the better, the fact remains that a central bank can manipulate interest rates at will through government bond markets. In the case of the US government and Federal Reserve, the federal debt level is supported by low rates, and these have had quite a negative effect, these have had quite an effect on the world since the dollar is the world's reserve currency. The current system lets bankers at systemically important financial institutions, or sci-fis, misprice risk at an enormous scale because they have no fear of bankruptcy. The sci-fi banks cannot die, for it would be economic suicide for a government or country, a country's government not to bail them out. And we saw this in 2009 to the tune of several $100 billion theft. So, but of course, the banks wouldn't want to get that large, right? Too much concentrated risk, right? Yes, but the gigantic systemic tail risk is covered by the public because all of the risks, all of the loans foul at the same time, and then who bails them out? It's not the bank shareholders, it's the shareholders of the government, the taxpayers that are bailing them out. So there's no need to factor that into lending decisions at scale. But even if the banks could get that large, they'd be stopped by regulation and government oversight, right? And no bank would want to lose money. So they'd have an incentive to only make good loans, right? Perhaps, but all of those things have already happened. Leading to 2008. If every bank issued its own banknotes, the free market would never allow one to accumulate too much systemic risk. It would devalue the bank-issued currency fairly based on the leverage and risk profile of the bank and curb the ability of banks in aggregate to amass asymmetric risk. One may say that that would be impossible without perfect information, but new innovations in blockchain and identity technology will soon make it more realistic. What central banks do is control the price of money through interest rates. This isn't a free market for money where holders of capital lend to earn the highest risk-adjusted return. In that system, the market sets interest rates. In our system, interest rates have been set near zero for almost a decade now. So as long as people accept a debt-based fiat currency that's inflationary and is designed to lose value over time, then their power is going to be surrendered to the centralized powers in government and at central banks. Whereas if we adopt a decentralized and deflationary cryptocurrency over fiat, central banks could still exist, but their power would be greatly limited. in my opinion, this will be a good thing. It would also enable people to have proper savings. For the past 10 years, savings have essentially been stolen from the public. If you want to save your money in the United States, you have a couple options. You can invest in domestic assets, which are overvalued. Why are they overvalued? Because the net present value has been inflated because interest rates have been dropped so low. Or you can invest in the US dollar, the physical currency. But of course, as we know, over time, inflation is going to reduce its value closer and closer and closer to zero. Also, it's my personal belief that the banking system, corporatism, and globalized trade have all served the interests of capital instead of labor over the past 40 years. This is evidenced by the reducing share of GDP to labor from 54% in the 1970s to 40% now. Coincidentally, government spending as a percentage of GDP has risen during that time and inequality has gone up. So more government spending as a percentage of GDP has led to more problems. It's also led to an addiction to debt, which is why this system is so entrenched and it's almost like there's no escape. Unless, of course, people start to abandon the dollar and go to crypto. And this is why if you read the news, there's so much fear being put out there about what will happen. You talk about the Central Bank of India banning cryptocurrencies. You talk about financial regulators everywhere concerned about cryptocurrencies and what their effects could be. Why? Because they have the most to lose, because they know that their mere existence depends upon being able to manipulate these markets and sort of put debt and make people pay just by holding the currency. That's inflation. You're paying the cost of additional government borrowing just by using this currency. So it's my opinion that we're seeing a huge shift. The volatility that most of you have probably heard of in the crypto markets is a result of more and more people leaving the fiat system and investing their money and their savings in cryptocurrency instead. And that's why we see huge spikes in price. And we're going to continue to see those huge spikes in price and volatility as long as there are more people that can flee the fiat system. However, if we compare the price of, let's take a crypto asset, Bitcoin, versus a fiat asset, the US dollar, we see that the market has already valued the dollar at next to nothing compared to Bitcoin. That price chart is the same as like a pump and dump penny stock. It's something that only happens when the market assigns next to zero value to an asset, and that's the US dollar. So I have a lot more to say, but I'd like to give the opportunity for Professor Terzi to give a little spiel on what he thinks. And obviously, he's one of the respected macroeconomy professors here at Franklin. So one last thing from The Economist. The Economist is one of the leading, obviously it's called The Economist, so it's one of the leading publications on the global economy. And they identify 4 problems with crypto. 1, trust. In their opinion, most consumers and businesses have faith in government-issued currencies. Number 2, sovereignty. The potential for tax avoidance and loss of financial control, which means that governments and central banks will not be keen to see private cryptocurrencies take off. Number 3, privacy, because they forgot about Zcash, Monero, and other private private blockchain assets that cannot be traced, and the irreversibility of transactions, which, depending on who you ask, is a good thing. To quote The Economist, on top of all these problems is the fact that existing alternatives seem to work perfectly well. It is easy to make payments and to transfer money in an instant. So what is the appeal? Well, cryptocurrencies, according to them, may be one of the few ways to diversify savings out of domestic assets, as I mentioned. Those domestic assets are overvalued due to low interest rates, meaning that savings will be devalued when mean reversion takes place, i.e. in a global financial crisis. Crypto enables people to save without having to buy overvalued assets or a currency that is designed to lose value over time. So as you see, The Economist points out subtly that really what the governments and central banks are seeking is financial control. But in my opinion, having that financial control centralized is a gigantic risk for the economy, as we've already seen from the hundreds of billions that were stolen from the people in the past financial crisis. And we'll see what happens, but I don't think if this system stays the same, that we're going to avoid a future financial crisis.
All right, Professor Terzi?
Well, first of all, thanks for inviting me. I look forward to a fruitful discussion, especially questions from the audience at the end of this debate. So I enjoy being here. So far, so good. I've been invited here to be supposedly on the side of fiat currencies. And so basically speaking pro-fiat and counter cryptos. Assuming that we agree on the terminology, I think I'd like to begin with, I'm not responding to your introductory remarks, but providing my own view of this issue. And I think we should begin with, first of all, clarifying some definitions. Cryptocurrencies are about a groundbreaking technology that has basically resolved one big issue that has been searched for many years since the digital revolution, and that is to create a digital object that cannot be replicated, and once it's owned by someone, cannot be owned at the same time by another person, which of course is very different from sharing files, which we're all familiar with. We share files, we copy and paste, so that no, this is the technology that makes it possible to create a digital object which is only in one place, or at least it's only owned and controlled by one entity. I'm saying digital object. I could also say a distributed ledger. Basically, that's also a way to describe the blockchain. And so it's a very powerful technology, and which is very likely to make it possible to do the same things that we do in a more cost-effective and better way, and maybe even doing new things. So I see this technology challenging a number of services, a number of jobs, a number of industries. Anything that is based on ledger, on some kind of a ledger, can be done with blockchain technology. So, for example, ledgers that record the ownership of property. So I think this might also impact on the job of lawyers, notary services. Once the change in property can be, in fact, realized and secured and confirmed through a blockchain ledger, through a distributed ledger. And there's so many things that are already happening. Central banks are already testing the transfer of financial assets, and especially government securities, using blockchain technology. So this is where I see the innovative side of this very important innovation, and the possible uses of this technology in the future. Now, of course, when we get to Bitcoin craze, then this is very much about displacing the national currencies, which is maybe possible if the cryptocurrencies can do the same things in a new, cost-effective and better way. But this is my definition of cryptocurrency and blockchain, and this is how I see this particular technology, this world, and how this world may impact on things that we do today in a different way, and we'll be doing this with these things in a different way in the future. Let me move to fiat. Fiat can be used in different, again, definitions. Always definitions are extremely important, as you know from my classes. Because using different or confused definitions may lead to confused debate. One way to identify fiat is national currencies, basically currencies which exist by law, right? And now, if we consider fiat currencies, national currencies by law, and the other, as I described, is the technology, well, the two things don't necessarily clash. And under these two definitions, crypto and fiat can be pots, and can be good pots, can go together. And what's happening this week at Franklin, that is the creation of a cryptocurrency version of the Franklin franc, is an example of this. We have basically a fiat currency, the Franklin franc, and in the technology of the blockchain applied to it, so the currency doesn't lose its status, its structure, its value, and the blockchain is an alternative to the use of banknotes. And by the way, in this experiment that pilot program that we're running, starting this week, will let students decide whether they want to use banknotes or the digital wallet. So in this sense, this is happening in Franklin, but of course central banks in the world are studying this, and the Bank of Sweden has announced that they should move next year to cryptocurrencies of their own currency. So the two things may go together. And so this is happening. The other way in which we understand fiat is unbacked currency which is not backed by anything else than people's confidence, people's trust. So basically we're talking about, and the word used fiat, that comes from Latin and from Genesis, it indicates an object that is worthless, with no intrinsic value, and that we accept because we expect that others will also accept it. So it's all based on confidence and trust. Then if we define it this way, the Bitcoin is also fiat, because it's unbacked and it's accepted only as a matter of confidence, on the basis of confidence. And on the basis of confidence that people will accept it. So, so in this sense, we find counterintuitively maybe that the two things are the same. That the Bitcoin is fiat, it's unbacked, it's not backed, it's a digital object, worthless as such, has no intrinsic value, but to the extent that people are interested in it, they accept it, they trade on it, it may have value. And so Bitcoin is fiat. So there's no conflict here. The idea, in fact, if we go this way, we describe a world where we may have several fiat currencies, all based on confidence, and the best wins. This is not an idea of Milton Friedman. Milton Friedman believed that central banks have a good reason to be the monopolist, because in Friedman's argument, if we let people compete on their currencies, because currencies are worthless objects, and because the cost of production of these things, the marginal cost of production goes very quickly to zero, the value of these competing currencies will all be zero. So we'll have a chaotic result. So Friedman was in favor of monopoly of the currency. But another economist was in fact in favor of competing currencies. And this is Friedrich von Hayek. He claimed, he envisioned a world of competing currencies. And again, the best wins. So they're all based on confidence. We'll let free markets decide. And that's another approach. But there's also a third option or third approach to fiat. And that is based on a different notion of how the currency originates. We know that a very much told story is that currencies originate from the need from free market people needing to find a way to facilitate trade. As if there was ever a world where people traded without currency, without money of some sort, and at some point they invented money to facilitate trade. Well, things in fact historically have evolved very differently. There is a fascinating book in the library on front of this auditorium by Christine Desagne, The Making of Money, and she reconstructs the whole story of money in a very different way, and basically explains the origin of money as being an invention that originates from the sense of community. So contrary to the idea of central planning and being repressed from some above, no, this is a way for the community to work together. And this is because the currencies originate from when a community starts acknowledging members of the society when they contribute to the community with a token, with some recognition. In most cases this was military services, but not only military services. And once you have a community and a number of individuals who contribute to the community and get credit, a token, a symbol of recognition, they're all creditors towards the community. They all have a claim on the community. And it's a very short step from using these tokens as valuable tokens that private individuals can also exchange between each other and start a market, start a real market, and start trading this way. This is in fact pretty much visible in the Franklin Frank Community Engagement Program, as it is called. The idea behind this is that there is a issuer, that is the Department of Economics and Finance. There are students who do volunteer work who all have a credit on the Department of Economics and Finance, and they know that they will they'll be able to use these credits to pay their taxes, to pay their liabilities, which is a way for the department or for the state in the story of the origin of money. The taxes are a way to distribute the burden of contributions to all people. So in the Franklin Frank experiment, you have that all students have claims on the central institution, and that gives value to these banknotes or tokens in their digital wallets, and they have an opportunity to exchange these things with other students, and these will be accepted, not just for just a matter of pure confidence, although confidence is important, but in a different way. Not just a matter of confidence, but because this is given a value, because everyone has a credit to the central institution. At the same time, the institution places a tax burden on everyone, and that gives value to these tokens. Confidence, of course, also important even in my story, because the confidence matters when students need to have trust that the program will continue next year. If I announce today or this evening that the program ends, nobody would be interested in doing any volunteer work for earning Franklin francs, and the program the banknotes would be worthless. Anyone who owns a banknote today, unless he or she has taxes to pay in the courses taught by my colleague and my courses, all these things will have zero value. So it all depends on the relationship between the community and the individuals. So this is one of the lessons of the Franklin experiment. So in this sense, and I'll conclude this opening remarks with this. Very innovative technology which will change the way in which we do things. Although I can also add a little word of caution, because we've seen a number of technologies that we were very enthusiastic about, and they were quickly surpassed by another technology. So probably this technology will be changing our lives, or maybe there will be another technology which will replace it. But clearly this is the way, this is the direction we're going. At the same time, we should be very careful in contrasting crypto with fiat for the reason that, as I said, if we define fiat as unbacked, well, the Bitcoin is also unbacked, Ethereum is also unbacked, everything is unbacked. But if we consider that national currencies are not really unbacked, they correspond to the contribution that people have given to the state, and they are the tokens that permit people to pay their taxes, their liabilities, and pay their liabilities, then we see a difference. Bitcoin doesn't have that, and because it doesn't have that, I'm not sure that Bitcoin has any fair value. It's a digital object that has value as long as people are interested in it. And we've seen how the value has been fluctuating extremely much in the past. Also notice that a number of people, as far as my knowledge is about the market of Bitcoin, there is very few people now who really trade in, who really make payments in Bitcoins. Most people speculate on Bitcoins and buy it in the hope of selling it at a higher price. And the higher price is denominated in what? It's denominated in dollars. So these people are in the Bitcoin market to make money in dollars. They don't care about Bitcoin. They care about dollars. They want to get rich in dollars. They don't care about getting rich in Bitcoins. Also, in concluding remark, there are cases in which, there are private companies that accept Bitcoins. There are even public institutions that accept Bitcoins, like in this country. Like in this country, the canton of Zug and other local, regional governments. Interestingly enough, they use Bitcoin as a payment instrument, not as a means of payment. And I explain what I mean. They accept it as a payment instrument, meaning that they accept that the payment is done in Bitcoin, but as soon as the Bitcoin is cashed, they convert the Bitcoin immediately into Swiss francs. So at the end of the story, if a citizen owes 200 francs for a fine to the canton of Zug, the canton of Zug will cash 200 francs, not Bitcoins. Bitcoin is only the transition from the payment to the cashing the Swiss francs, but the canton of Zug is not interested in storing Bitcoins. In fact, it would be quite a risk factor for Swiss taxpayers, I believe. And I end here for the moment.
Well, thank you for those remarks, Professor. Michael, do you have any, as the moderator, anything that you think I should address first, or?
I think we should definitely have a response to both of you guys should respond to each other after these opening remarks. I think it was very mind-opening. They're going to take some questions, so get them ready. All right. But I'll time this, so it won't be too long. You have 5 minutes to respond.
All right, great. Thank you, Professor Terzi. I think he made the point that in order for a currency to be accepted, there needs to be a market for that currency, and governments that accept their own currency as a form of tax payment sort of guarantee that market. So in that regard, the US dollar does have, and other fiat currencies that can be inflated do have some value. However, in comparison to crypto, and cryptocurrencies that are deflationary and cannot be inflated, or there's no monopolist central bank or currency issuer that can interfere in that market, that has the effect of essentially making the cryptocurrency objectively a superior asset to hold relative to the fiat currency. The main value of the fiat currencies that exist today, like the US dollar, is to enable the US or enable banking systems to perpetually create a certain amount of inflation such that the risk of lending goes down. Of course, as we know, as we've learned in Professor Terzi's classes, deflation is a gigantic risk when it comes to banking and when it comes to lending. So there are a lot of positive attributes, let's say, toward government-issued fiat currencies. However, objectively speaking, if you are a holder of capital and you have the option to choose to invest or hold your money in your savings in cryptocurrency, a decentralized, deflationary cryptocurrency whose supply cannot be altered, it's objectively superior to a fiat currency that has a purpose of being devalued over time to perpetuate the banking system. And it's not necessarily that the fractional reserve banking system is a problem. Obviously, it's created vast wealth for human societies over the past 150, 200 years or so. However, it's objectively inferior. And I think if you look at scenarios in which investors would lose faith in the US dollar or US debt, well, they would only do that if presented with a worthy alternative, right? And that alternative is decentralized deflationary cryptocurrency. Not just Bitcoin. I want to stress that point. It's not just Bitcoin. Bitcoin is one of the first, but more innovation is coming. In fact, I've identified four main areas, let's say, areas for innovation within cryptocurrency. If I can find them here briefly. Right, so future problems to solve will include identity attestations. This is being worked on and is being solved. Decentralized exchanges. This is being worked on and this is being solved. A credit and lending mechanism that operates using decentralized deflationary cryptocurrencies as opposed to fiat currencies. This is being worked on, this is being solved. And of course, the biggest one, extremely low fees and scalability for a cryptocurrency. This is being worked on and will eventually be solved. And when it happens, it's not necessarily going to be Bitcoin, but that is going to be a vastly superior asset to hold than Professor Terzi's enamored fiat currencies that are government issued. Another big point, 30 seconds left.
Yeah.
All right, another point I wanted to make is that basically when it comes to paying taxes, people should live in a system where you choose to pay, like local property taxes. You want to send your kids to a good school, so you live in a community that has higher property taxes, rather than having a government that can simply extract whatever it wants from you without necessarily having, apt cause in order to be able to do that. So, for all of these reasons, I think that we're going to see capital continue to flee from fiat, and therefore we're going to continue to see a run-up in the market capitalization of cryptocurrencies. Ultimately, it's not about the currency itself. It's about what the market turns into when you use a fiat currency that's backed by a central bank. When you use a fiat currency that's backed by a central bank, the central bank can have an outsized influence over the behavior of that market, as we've seen in the past financial crisis. When nobody would ordinarily purchase U.S. government securities in the secondary market, the U.S. Federal Reserve can step in and do that. And we've seen that. We saw that with the purchase of $4.5 trillion of U.S. government securities from 2008 to the end of the last round of QE3. And the only...
Time's up, bro.
All right. I'll end it there.
All right. So thank you, Connor. Let's give him a big round of applause. Now we're going to have Professor Terzi's response to Connor's opening speech.
Just a couple of quick observations, hoping to leave some time for the audience discussion. If you plan to wrap up until 8:30, it's okay from there. One thing that I really share with Connor is the concerns about the way in which the financial crisis is being managed. So if you ask me if I'm happy, if I approve of the way in which bailouts have been managed, monetary policy is being managed in the crisis, quantitative easing, or fiscal policy. The big absent in this discussion is fiscal policy. No, I have a number of concerns about the way this has been managed. So there's no question about that. Stressing specifically fiscal policy, because fiscal policy is really the way in which the national currency gets into circulation and gets withdrawn from circulation. Think about the Franklin franc again. The way in which Franklin francs enter circulation is by government spending, is by Department of Economics spending, encouraging students to do volunteer work and paying students to do volunteer work in the community. And currency is withdrawn from circulation when we tax students. We don't do any monetary policy. We only do fiscal policy. Monetary policy is zero because we have zero interest rate. There is no interest rate on the Franklin francs. If we want to start with monetary policy, we could offer students a way to give us the banknotes and give them a credit with interest. And this would create an interest rate on the Franklin francs. But we're not interested in doing this, so there's no monetary policy. Fiscal policy does it. And that's the other big absent entity in the cryptocurrency world. There's no fiscal policy. There's no mechanism that injects or withdraws money from circulation. And fiscal policy is the source of savings of the private sector. You talked about savings. And savings are always the other side of debt. So you can't really say that you would like to have a society with less debt and more savings, because savings and debt are the two sides of the same token. When you save with buying financial assets, these assets are your claim and it's a liability to somebody else. So of course you can save in real terms, buying a property, buying land, buying bitcoins. That's a real asset. It's not a financial asset. It's a real asset because there's no liability on the other side. Or you accumulate financial assets, which is the financial savings that we have, that we aim for, and all the savings have a debt on the other side, either a private debt or public debt. So that's the thing that is missing from this design of how cryptocurrency could save the world. The other point, quickly, is the concern about inflation. I don't know where is all this inflation. All central banks are trying to increase inflation and they can't. which means that central banks are in fact defenseless against deflation.
Well, they've created plenty of inflation in the asset prices. So they've created asset price inflation.
I'm not sure about that either, because one could even argue that the natural rate of interest is zero, and the real manipulation of interest rates is to raise interest rates and depress the price of assets for no purpose. So, and also remember, talking about inflation reducing the value of the dollar to zero is also inaccurate, because prices are always somebody's income, as you should all know, and so rising prices also means rising incomes. So that doesn't change the purchasing power on average. It does change distribution of income, which is another question, another problem that we haven't discussed tonight. Although there's lots of income distribution as a result of Bitcoin trades, because Bitcoin trades basically means that dollars move from one person to the other as Bitcoins are traded. So somebody loses dollars and somebody earns dollars or gains dollars as a result. So some people lose their shirt with Bitcoin, and some people get rich. And again, they get rich in dollars. They don't get rich in Bitcoins. They get rich in dollars. So there are a digital object, a speculative object, just like rare stamps or other precious objects that people like to collect and trade and have value. Nothing to be against it. The only thing it might be that
1 minute left.
Okay. The only thing that might be that speculation on Bitcoin may entail borrowing and creating a stress credit situation for people who really are serious in trading in Bitcoins. But again, this is a risk for the currency and not for Bitcoin. But I'll end here.
All right.
So we have a chance to.
Thank you very much for your responses. Now, I want to know what you guys are curious about. So, what questions do you have? Professor Rocor.
I have two very brief questions. I hope they're brief. One, I think I was going to ask Professor Terzi about, irrespective of adopting a cryptocurrency, what was the extent of your agreement with Connor's presentation about the pathology of the current central banking system? I think you addressed that in the first part of your response. So I'll just leave that. My second question has to do with the fact that creating a Bitcoin has a certain cost of the so-called mining, and that's electricity and other things that go into it. And I'm wondering if you can offer us any thoughts about what determines that cost, and does that provide a floor for the value of Bitcoin, although, as Professor Terzi points out, it's a physical object and we can put any price we want on it in terms of our potential demand, like stamps.
I can jump on the second question. That the president of the BIS, Carstens, has stated that Bitcoin is a combination of a bubble, a Ponzi scheme, and an environmental disaster.
The electricity cost.
The electricity cost, which was nothing years ago, but is now extremely high, producing additional Bitcoins. But I missed the first question.
If you put aside the question of whether we should, in a normative sense, or will, in a sort of positive historical sense, go to Bitcoin, if we put that question aside, do you agree with the general thrust of the pathologies of the current central bank system coming out of the 08, 09 financial crisis? Do you agree with Connor's description of the pathologies of what went on in that time, and then how it came down to the government bailout?
Yeah, well, when I said that I share those concerns, yes, I do. But I would focus my criticism much more on the way fiscal policy has been managed than monetary policy. So, for example, QE, what I think of QE is not very useful, not very damaging, really, very limited, or in other words, a lot of effort to achieve a little result. And the little result is slashing interest rates on the long distance, so to speak, which the central bank could do technically in a more easy way, but okay. So, so it's not so much the monetary policy that's been the problem, but, and of course there is also the problems with regulation and the problem in which the bailout has been managed. But there's a difference between the financial crisis and the economic crisis. And if we have, and I don't know what we have in mind when we look at the goals of the economy, but to me, the primary goals of the economy is create a full employment scenario with price stability. That's basically what, you know, and I would agree with Connor that this is not being achieved by the current system, but not because we have currencies designed in this way, but because they're not well managed. Not that they have never been managed well, because there are times when they were managed better, and we had strong economies. But with the last 10 years, we've seen a lot of problems in managing correctly the national currencies. So the answer is manage the national currencies in a better way, not necessarily switching to something else, because that's also not possible. The government will always tax people, and people will always need the national currency to pay their taxes.
Connor, can I ask you to respond to the question about the cost of Bitcoin?
Absolutely. So I think that, you know, as a lot of people have mentioned, there is a high cost to mining Bitcoin and other cryptos. However, that cost is also an opportunity for the market to solve. And I believe that the market will solve that problem over time and increasingly in a better and better way. Also, I'd like to point out that the current US financial system, just to point out, is something like 15 to 20% of US GDP, right? It's it's millions of employees. It's millions of buildings. What does it cost to operate the dollar in electricity terms? I think it might just be a little bit higher than cryptocurrencies. Maybe just a little bit. Okay, we're talking 18% of US GDP. That's the cost. Okay, it's huge. So is there the cost of maintaining the US financial system?
Oh, the financial system is too big.
Okay, so he's in agreement.
We should downsize the financial system. That we agree.
Right.
Lots of inefficient and useless stuff that's been done by the financial markets. Including speculating on Bitcoin.
Well, Bitcoin is just one cryptocurrency. So I think that, Professor, your second question again, if you would remind me?
I think we should let other, I understand what you said about cost.
But the second question.
Oh, that was specifically for
Sounds good. All right, let's move on. Casey, you have a question?
Thank you. Yes, well, Connor, I'm very curious here. So you're arguing that all these flaws with cryptocurrencies are just going to be worked on and solved, and given no backing as to how they're going to be solved. And the cost of the home and the cost of electricity is around 3 million U.S. homes in the last year for all cryptocurrencies. That was almost at its peak too. And you're saying that the cost of financial institutions is slightly higher. I'd assume it's slightly higher if it's the backing our entire country's finances. I mean, it seems like a massive waste of energy to be employing these, to be just wasting it on cryptocurrencies when it's very unlikely they'll be used in the general currency. They might be used as a through currency for their sake of privacy and whatnot, but that sake is almost completely diminished by how the US has already operated over the cryptocurrencies. You have to give all your information and your tax information if you ever want to try and trade cryptocurrencies on the US market. There's way different tax laws than it is when it comes to trading normal securities. So what's the benefit then to trading these cryptocurrencies as an actual holding currency instead of going as a through currency?
Okay, the benefit is you have two options, okay? You have one option where people can steal from you at will and plan on doing so. And then you have one option where your fortunes are tied to what the market thinks. So the fiat system, you can be you can and will have your savings stolen from you. And in the crypto system, you're essentially betting on whatever the market will say the true value is. And there are ways to hedge around that. But with fiat currencies, you will have your currency that you hold be devalued over time, unless there's deflation, which will cause a banking crisis, which could cause even more problems.
Okay, that makes almost no sense, but I'm gonna just rebuttal anyway. So you're saying that there's no chance of a cryptocurrency being stolen? There's been over $50 billion of cryptocurrencies that have been stolen. In China alone, XIV, over $500 million was stolen, and it has still yet to be recovered. This is over 3 months ago.
That money,
still yet to be recovered.
Excuse me? That money was stolen from exchanges. If you have your currency in a paper wallet, it cannot be stolen.
You are, okay, I'm sorry. Maybe okay, what do you say?
Can I get Michael to confirm on this?
That's a fact. Blockchain, you cannot steal from it, and it's been stolen from exchanges.
You can steal from exchanges.
I understand, but if you're trading
it's a security
it's
issue.
from exchanges.
1 second.
Yeah, so you don't have to use
All right.
exchange.
We'll have a debate with you next time, all right? Because you're so wrong on it on so many levels.
No, but tokens can be lost forever.
They can't be
in the
lost.
system.
Exactly.
Yeah.
But they cannot be stolen.
Okay,
If
but
you
you're not going to trade on
if they're stolen due to social hacking, people failing to keep the code secret, not because of the system.
How are you going to trade on any type of secure system if you don't have any type of market that you're going to be trading it on that it can be stolen from?
A decentralized exchange. A decentralized exchange. A decentralized exchange.
Okay, how does that work? Okay,
All right, we gotta move on.
Next question, Carlo.
I have a question.
Thank you for answering our questions.
We
can't hear.
What would happen if, for example, you leave 100,000 on the street, like on the parking lot? Would someone take it?
That's true.
Someone would take, so like similar things happening here, like the money wasn't protected.
Well, not exactly.
Yeah,
It's not exactly the same.
It's not exactly, but it's
Security of the system of payments is different from leaving cash on the parking lot.
close.
The system, but the system is secure. Other systems, corollary systems like centralized exchanges, what have you, or people storing their private key in a stupid in a stupid way. Yes, those are not protected by the system. But we're not talking about that. We're talking about
That's like stealing a purse.
right.
Yeah.
We were talking about the viability of the actual system, not some corollary system. Other questions?
All right, do we have more questions?
I want to understand one point before I ask my question. So we're saying that to move from crypto to fiat currency, government needs to actually invest or actually keep cryptocurrency and not exchange it to fiat currency. And if that actually happens, is that true? Like, does that need to happen for the move?
And I disagree.
You think government will still exchange crypto into fiat even if it accepts it?
I don't think that governments need to accept cryptocurrency for cryptocurrency to take over. It's more about people deciding they want to abandon the fiat system because the fiat system has allowed money to be stolen from them and continues to allow that.
But if that actually happens, the government will be forced to accept because the
Correct.
currency will deflate.
Eventually, yes. If people start,
Trusting fiat currency.
exactly, the governments will have to use
actually
crypto.
will be forced to invest in crypto. And if government invests in crypto, they will have to make fiscal policies based on cryptocurrency.
They'll have to borrow in cryptocurrency. That's what I'm saying. Not necessarily invest in cryptocurrency.
But, that means they will have to create fiscal policies relating to cryptocurrency instead of fiat currency.
Okay.
That basically what I think that defeats the whole point of cryptocurrency if the government starts making fiscal policy on cryptocurrency.
No, it wouldn't because they still wouldn't control the market because they don't control the supply.
But the cryptocurrencies that will be created are the central banks that will create the cryptocurrency.
No. The cryptocurrencies that will take off are the ones that are going to be chosen by the holders of capital, those people that want to invest their savings, and they're going to be decentralized and deflationary. So banks and governments are not going to have control over them. They will be able to buy them and sell them, accept taxes in them, pay wages with them, but they're not going to have influence like the Federal Reserve or the European Central Bank or the Bank of Japan do today, which will, in my opinion, reduce their ability to borrow, which, according to Keynesians and neo-Keynesians and people that think that government should, be able to regulate the economy in a centrally planned way by creating arbitrary inflation targets, et cetera, and adding on debt as a remedy, their ability to do that is going to be diminished because they're going to have to play by market forces. And I think everybody who's a participant in the market wants the market to be the most efficient because that's going to increase their own capital and wealth. In order for the market to be most efficient, you can't have somebody that can manipulate the market at will. And if people use fiat currencies, the market can and already has been manipulated at will. And Hayek, I believe Professor Terzi, to get one more point out, mentioned Friedrich Hayek, the Austrian. And I believe if he was here today, he would be 100% behind my way of thinking.
Keynes was not about central planning. Keynes was about saving free markets and capitalism from central planning and communism. This is what Keynes was about.
I understand that.
Okay.
But at the same time, he thought that supply and demand, basically, if there was a shortfall in aggregate demand, government should borrow, right, in order to fill in that gap.
Not necessarily borrow, but the aggregate demand depends on how the government manages the currency. So if the government doesn't provide enough currency to people that they need for their savings, the government is not doing its task well, and should in fact fix it by changing the fiscal policy appropriately.
Right, and part of fiscal policy is debt.
Yeah, so the governments are likely to continue to issue their own currency because that's the way in which they provision themselves. Remember that governments must first spend and then we pay taxes. The same way as Franklin Frank goes. We need to spend the Franklin Franks first, then the students are able to pay their taxes. It's not the other way around, as sometimes media describe the situation. So one can envision a situation where people move to cryptocurrencies, but that will leave an economy with a dual system of two currencies with a lot of exchange rate risk. And I'm not sure if there is enough incentives for people to build an enormous exchange rate risk when they know that they have a tax liability, they have savings in the national currency. So we'll see.
Okay, more questions.
All right, from now on, we're going to cap off the questions at 2 minutes. That way we can get more out.
Or less.
Yeah. All right. So, Dylan?
Kind of building off what you just asked, my main concern with cryptocurrencies is the taxability of cryptocurrencies and how cryptocurrencies can actually be implemented in states. Like, how can you make sure that people actually pay what they make if it's valued in cryptocurrencies? And also, how will they pay, like, let's say the value of what they made when they made a ton of profits is here, and then when they come to pay their taxes, the value of the cryptocurrency is here. What do they pay?
Good question. I'll give you a first crack at it if you so choose. Well, there are a lot of...
That's the question for Connor, I think, right? Yeah.
So there are a lot of issues like that. in terms of government collecting taxes, it's going to be more difficult if we move toward a crypto system for governments to collect taxes. One thing that's coming is a global identity solution that, along with a non-anonymous cryptocurrency, so as opposed to like a Dash or Monero, but like a Bitcoin, where you can see what address has sent what. So pairing that with an identity system will allow for more regulation, and that is already in the works. In terms of, yeah, I think, I don't know, what other questions did you have? It's kind of a string.
Also, how would they be able to, like, let's say when you go to pay your taxes, the value of what what you made was much higher 2 months ago, and then when you go to pay your taxes, the value has totally fluctuated. How many cryptocurrencies, that's short coins do you pay?
Right.
That's exchange rate risk I was talking about.
Yeah,
Right.
How would they be able to?
So-
Once you have a dual currency system, it's very risky.
I think it's risky under the assumption.
Yeah.
It's risky under the assumption that, like right now, we have so few people as a percentage of the population that are actually using different cryptocurrencies. When that number grows, the volatility is going to decrease commensurately.
All right, Carlo.
Next question.
So I would like to know who profits and who can profit when it comes to.
You gotta speak louder, man. Can't hear you.
I would like to know who profits and who can profit when it comes to fiat currency production versus cryptocurrency production. One question is for
Okay. Professor Terzi, you can go first.
Who profits?
when it comes to fiat currency production. And who can profit?
I'm not sure how you define these profits. I mean, central banks are profitable by definition, although these profits are really accounting profits. They're not creating real wealth. They're responsible for providing the national currency to the economy that is necessary to provide the possibilities to achieve the desired macroeconomic goals. So there's no real profit in the straight economic sense. In the same way, there's no profit for the cryptocurrencies except the capital gains that you can make by buying Bitcoins low and selling high, which corresponds exactly to the capital loss of somebody else who bought it high and sell it low.
My take is a little bit different on this one. So who profits from fiat currencies? Well, who benefits, right? And for example, the US government has benefited from the fiat system because it's been able to borrow for the past 10 years at below market rates. The market would not have had interest rates at near zero, but they've been able to borrow at near zero. So they've definitely benefited in that regard. In terms of who benefits with cryptocurrencies, well, anybody who mines cryptocurrencies benefits in terms of what it costs to mine versus the market value of the currency that they hold, right? And that's a market that anybody can participate in. All you need to do is buy mining equipment, application-specific integrated circuits, different computer systems to mine the cryptocurrency. So it's essentially a free market, and therefore.
Not cheap. And not everybody has access to the internet speeds that are required to actually make money, and it's high energy costs.
True, but that doesn't mean it's not a free market. That doesn't mean that it's not a free and competitive market. The competition has been increasing steadily as the rewards for mining have gone up. So I think, contrary to what you're saying, we actually do see a free market in cryptocurrency mining.
right. Thank you very much for coming, guys. Thank you, Professor Terzi, for coming. It was an honor to speak on this topic.
Thank you for being here. Thank you very much for inviting me. Thank you, Connor.
Thank you.
Thank you, Connor.